A/ZH/N. Good morning, everyone. Let's start with a look at the global market performance overnight. All three major U.S. indices closed lower yesterday. The Nasdaq Composite shed nearly 0.9%, settling at 26,853.98 points. The S&P 500 also declined by 0.74%, closing at 7,553.68. The Dow Jones Industrial Average saw the largest drop, falling 1.21% to finish at 50,687.07. Sector-wise, energy and industrials were hit hardest, primarily dragged down by a sharp fall in oil prices and growing concerns over a potential recession in Europe. However, the futures market presented a mixed picture. Nasdaq futures were down 0.55% pre-market, while S&P 500 futures edged up 0.1%, and Dow futures surprisingly gained 1.01%. This suggests a potential rotation of capital from growth stocks towards traditional blue-chip names. Interestingly, despite the broader market downturn, two key ETFs, QQQ and SPY, moved against the trend, rising 0.8% and 0.5% respectively. This indicates that funds at the ETF level are actively buying the dip, suggesting underlying resilience in the market. Moving on to the global macroeconomic landscape. The U.S. 10-year Treasury yield continued its downward trend, settling at 4.46%, a decrease of 0.76% from the previous day. This confirmed downward trajectory signals clear liquidity easing, which is a positive for global asset valuations. The VIX Volatility Index, often referred to as the fear gauge, rose slightly to 16.37. While it did tick up, it remains well within the normal range of 15 to 25, indicating a cautious market sentiment rather than panic, thus alleviating concerns of systemic selling risks. The US Dollar Index, DXY, continued its weakening trend, falling by 0.24% to 99.24. This marks the fourth consecutive day it has traded below the crucial psychological and moving average level of 100. This technical weakness is a clear positive for emerging market assets, including China's A-share market. In the commodities space, WTI crude oil saw a significant drop of 2.63%, closing at $92.61 per barrel. This decline is predominantly driven by lower global demand expectations, further reinforcing the existing concerns about a global economic slowdown, and pointing to a bearish supply-demand fundamental. Conversely, spot gold had a strong showing, surging 0.99% to hit a new yearly high of $4,535.20 per ounce. The combination of falling U.S. Treasury yields and a weaker dollar acted as a dual catalyst, attracting both safe haven and speculative capital into the gold market. In summary, the global market currently appears to be in a risk-on mode, with declining U.S. bond yields, a weakening dollar, and rising gold prices forming a classic combination of liquidity easing and asset reallocation. Now, let's turn our attention to the renminbi and the external environment for Chinese assets. The onshore renminbi against the dollar, CNY, traded at 6.7730, depreciating slightly by 0.06%, while the offshore renminbi, CNH, saw a marginal gain of 0.05% at 6.7738. The narrow fluctuation in the exchange rate suggests stable market expectations, with no signs of sustained depreciation pressure. This stable exchange rate environment is beneficial for reducing foreign investors' hedging costs and enhancing the attractiveness of A-share assets. However, U.S.-China tech friction has notably escalated. According to a June 3 report by Nikkei, the U.S. Commerce Department is reviewing whether to add Yangtze Memory Technologies Corp., or YMTC, to its entity list, and may impose new restrictions on AI chip supplies to Huawei. This development represents the most